My name is Michael Duke, and this is the show where I analyze stocks that are interesting. So if you find that interesting, then please consider liking this video and subscribing to the channel. Exciting company to discuss today, one that I have a strong love for. I wanted to talk about Costco, given that a few days back I discussed Tesla. And I actually do see a lot of similarities between Costco and Tesla. Now, in the Tesla video, I gave a very negative review. Costco is a place that I shop all the time and a stock that I do hold and um, have no intention of selling, despite my opinions about its valuation, which we'll discuss in a moment. The similarities between a stock like Costco and Tesla, very simply put, it's a stock with a cult like following that appears to be driven largely by animal spirits, with fundamentals loosely correlating to the underlying price. One big difference between Costco and Tesla is that Costco is a much more consistent performing underlying business and has in my opinion, a far superior business model. There's a lot to like with Costco stock. So, as always, we're going to be talking about a description of the company, the thesis for why it has made sense as an investment. Does it have a moat, and what's driving the price right now? And we're also going to take a look at the valuation, the financials, and the dividend metrics. I'm going to discuss some of the risks. We're going to do a brief technical analysis, and then I'm going to give it my grade. So, yeah, stick around. We'd love to have you. As always, this is my opinion and not financial advice, not a recommendation to buy or sell a particular security. So let's get into it. So, what is Costco? If you're outside of the US, you may not be as familiar with Costco, as the majority of the stores are located in the United States. The majority of the stores are in the United States. I'm trying to find a general information report that talks about. I think this might be the most recent one as of January. This is better. So not only are there sales data here, but they also have their information. One thing of note, Costco is the only company that I know of that actually release monthly data. They don't release their earnings every month, of course, but they discuss their net sales, their sales, comparable sales, and this is the information right here that they release every month. Pretty interesting, right? But this is what I'm looking for. So, of the 897 warehouses, and 897 does not seem like a lot, does it? And I think that's a big piece of the story here. Not even 1,000 warehouses, 617 of which are in the United States and Puerto Rico, 109 in Canada, 41 in Mexico, 36 in Japan, 29 in the United Kingdom, 19 in Korea, 15 in Australia, 14 in Taiwan, 7 in China, 5 in Spain, 2 in France, and 1 each in Iceland, New Zealand, and Sweden. So, to my point, we got over 2/3 of the warehouses, about 2/3 in the United States, and drops off pretty significantly after Canada and Mexico. By and large, Costco is primarily a North American operation. One thing of note is that Costco does very well in Asia per store and enjoys very strong brand equity. In fact, that's kind of the name of the game when it comes to all of, or a big piece of the company's success is very, very strong brand equity. So, to that end, I want to discuss, does Costco have a moat? And I would argue that it has a very wide moat, and it's primarily driven by intangible asset, its equity, or excuse me, its brand. People, myself included, have a strong belief that with their Costco membership and when they enter the Costco store, that the prices they see and the prices they get compared to other retailers there's a lot of value there. But I think it's about more than just prices, it's about volumes. For example, certain goods that we know that we're going to buy regularly, routinely, and continue buying, we tend to go to Costco and buy them in bulk. And so that's kind of the value of Costco. I mean, it's in their name, Costco Wholesale. It's consumer facing, but it prices its operation like a wholesaler, in between several businesses. And the pricing is very straightforward. Everything is marked up by 14%, roughly. Each warehouse that's open, there's a emphasis on piecing together a somewhat unique supply chain to that region. Go into any Costco local to you, and then when you're traveling, go into a Costco and you'll see what I'm talking about. There's different things somewhat across each location. It's a funny gift that I got my wife, and it says, "Don't be like the yawning guy and drink coffee." So sorry if you're out there, yawning guy, but I used you as a cheap prop for a cheap gift. Anyways, the purchasing managers do seem, this isn't something that I know for sure, but something that I perceive, that in each region, there seems to be a very, very strong emphasis on sourcing goods very specific and very applicable to a certain target radius around the warehouse. But the way I understand it works is they just mark those goods up by a low, a very low double digits gross margin. And that's how their business works. So very, very simple. The allure of something like Costco is that it's not tech. It's not disruptive. It's nor is it likely to be disrupted given how simple it is. It's very simple. It's very cash generative. Their balance sheet and their financials are managed very well by the management, top tier management, excellent culture. Excellent culture. They pay their people well. They take care of their shareholders and they take care of customers. So, as a result of being very conscientious of all of the stakeholders, external and internal and otherwise, the company has enjoyed enormous success. And the results of the underlying business support that. So, do they have a moat? Absolutely. People trust in the brand and continue to shop there because they have faith that they're getting a deal. And it's not just made up. Costco has a lot of really, really good deals. So that keeps people coming back for more. And then you also have their business model, pay to play, pay to shop. That creates a really cash rich model and cash rich business, whereby when the company takes in revenues in these membership fees, these memberships, income, that they invest that money into low margins, low prices, good deals for customers. So, and then they have this modest level of expansion. So I think there's a lot to unpack there. We'll get into it, but yeah, the company enjoys a fabulous moat, and most retailers do not. As for what is going on with the stock price, it's really, I believe it's technically in a correction, as it's sold off more than 10%. It got up to almost $1,100 a share, which is crazy, and is retraced down to 900, though still outperforming the market. You see here, the company has had strong outperformance over the last year, over the last 3 years, over the last 5 years, 10. Indeed, the company has crushed the S&P 500. Even year to date, still has outperformed over the 6-month time frame. Only when we zoom in do we see underperformance here. So what's driving the price? Well, it's tough to say, but first off, the company is very richly valued and has been for some time, but it's been much worse in recent times, which places the stock price on shaky foundations. My theory here in recent underperformance largely stems from, the stock has really gotten overextended. But I also believe, sentiment wise, there's a big trade playing out. The video that I'm going to do tomorrow is going to dive into this a little bit more. There's a trade playing out right now where the American equity market is richly valued. It's the most richly valued of any market because it's outperformed so much for quite some time, 10 years plus, outperformed the other markets. There has been a level of American exceptionalism in market performance. That trend is showing cracks underneath the surface the last month or so, given the actions of the administration sending a signal. But then you also have this whole other element of that where there's been multiple instances of Chinese artificial intelligence tech that have been released. They have marginally better performance than like OpenAI or ChatGPT or, one of our companies at a fraction of the cost. So there's this kind of psychologically driven market movement going on right now between China and the US, somewhat of a rotation from our stocks to theirs. And you see that playing out in the Chinese stock index. I forget what it's named. The Hang Seng, I think is what it is up by quite a bit year to date, whereas the S&P 500 is down. Now, the majority of the companies that I have covered so far on my channel are American, and I don't dive too deep into the Chinese stocks. I have reasons for that. I won't explain that here, but I think that might be weighing on the price, even though Costco has operations in China. I think that there might be a lot of concern over tariffs and the fact that it's a retailer that sells goods, and a company like that is heavily exposed to tariff risk. So I think that that's what might be driving the stock prices. You see that there's a North American heavy weighted presence there. There's a rotation into other stock markets of the world. Costco happens to be in the crosshairs of that. Then you have the tariff risk, and then you have the valuation risk. So speaking of the valuation, we won't look at that first. First, let's look at the performance. Let's look at the income statement first. One thing to note, you see here, the sheer volume of the sheer volume of sales of goods passing through this business is insane. You see from August 2015, 116 billion of revenues to 264 billion. That's a lot of money. So it doesn't take a genius to see, again, market cap being 400 billion, doesn't take a genius to see that the price to sales ratio of this business is fairly low, as it should be. It's a retailer. So our revenues have gone up 116 to 264, a little bit more than two times. Two times would be 232. Our gross profits have gone from 15 billion to 33 billion. That's also more than double, slightly. One thing of note you see here, our gross profit is exactly as I'm saying, roughly 14% ish, mid, low teens, and similar here in that regard. One thing that I do want to do is we're just going to do a very quick and dirty calculation. 33 divided by 264 is 12 half. 15 divided by 160. That's not exact math. Gross margins been roughly the same, if not slightly lower over time. So it's not really indicative of this strong like margin expansion. And I think that belies how Costco doesn't want to aggressively expand margins in any particular operating period, because to do so would to have this strongly increasing gross profit might be to come at the detriment of their brand equity in that they're providing a deal. Now you see here operating income has gone up a little bit faster. Excuse me. A little bit faster here from 3.6 billion to 9.7. So there is, in other words, what I see are numbers where management has a very clear mandate of stable price markup here, stable, and then any sort of operational efficiency being driven here. Another thing to note: 9.7 billion of operating income versus 264. I mean, what is that? That's like 3 something percent, 3 point something percent. The only real difference is, yeah, that's also a little bit more than 3x there. One thing about Costco is that their financial performance is, there's a lot of latent energy in their financial performance. What I mean by that is that, we've looked at a stock like Visa, where they're just Visa and MasterCard, they're taking 100% of their free cash flow and they're returning it to shareholders in the form of dividends and buybacks. So in any given quarter, you have, out of 100 of shareholder returns, you have like 10% to dividends and the rest to buybacks. They're aggressively buying back their stock, and that's what's driving these mid-teens earnings growth rates. The accretion to shareholders is driven largely and somewhat by share buybacks. Costco doesn't, they buy back enough shares to make sure that their share count doesn't get diluted over time. You see here that their shares there were 443 million 10 years ago. There's 445 million today. So they don't really buy back shares. They're issuing equity as stock-based compensation, but they're not really buying shares down. So what's the positive element of that? You see the earnings per share growth rate almost tripling over that time frame, $5 to $14. That's completely organic growth. And if they were to plow a bunch of money into buybacks, it would drastically increase the rate of earnings growth. So I think that's what I describe as this latent energy in their financials. Is I think investors look at it and they're like, oh, well, there's other high performing stocks that are buying back all these shares. They do really well. Costco can generate good financial results without doing so. So there's almost somewhat of that priced in. Does that make sense what I'm trying to say? Taking a look at the balance sheet, there's a couple interesting things to note. I mean, even you just look at the trend here. The company likes to keep a lot of cash on hand. You see how that kind of compares to inventory. They keep even more inventory. But I mean, that gives you an idea. Again, there's latency tied up in that cash. When we look at long term debt, not really meaningfully expanded over that time from 4.8 billion to 5.8 billion. They have enough, they have, net cash. They have enough cash to pay off their debts and then some. So that kind of gives you an idea of how they go about their business. One thing I want to look at is here. For whatever reason, they don't have the most recent number here, but we see here gross property, plant, and equipment. I always like to assess that when I'm looking at real estate, and I don't look as much into accumulated depreciation. A company like this, they own a lot of their real estate. You see, their holdings have gone from 23 billion to in excess of 51 billion. Not sure why that number doesn't show up consistently. I'm sure we could take a look in the company provided financials. So what's interesting though is, in terms of the cash, the property and the book value, that translates to a book value of $57 a share. Remember, our share price is 900 something, $27 of cash per share. So although the company itself holds a lot of cash, it is certainly nowhere close to their market cap being 400 billion. But the balance sheet is top notch, grade A plus plus, very very strong. In fact, the fact that their cash is going up is somewhat of a signal that they have they must have some sort of internal ratio. They keep X amount of cash on hand. Um, the fact that their debt hasn't meaningfully ballooned over that time frame illustrates to me that when they are building new warehouse sites, that those sites are funded largely, if not entirely, with cash. And we kind of see we can take a look at that here in our uh, statement of cash flows here. You see here stock-based compensation. There's a somewhat significant amount of stock-based compensation here. 614 million in the 24 weeks, or basically half year, versus is that 412 billion, or excuse me, million of stock repurchases in the prior period they actually issued. So that both of these periods they didn't buy back enough shares to offset stock-based compensation. It seems to me that they actually don't want to buy a ton of their stock when it's at the absurd level that it's at now. So to that end, let's talk about the valuation. Seeking Alpha grades the stock at an F valuation. It grades incredibly poor in almost every valuation metrics. It's in consumer staples for the purposes of this analysis that Seeking Alpha is running here. At almost every single metric, absurdly different compared to the sector. One thing I do want to point out is that based on 5-year averages in every single metric, Costco is more expensive compared to the 5-year average. And the only things that aren't just like blaring F grades here are your price sales numbers. But even then, those are higher than other retailers. We might want to take a look at that in our chart analysis. But just take a look at some of these numbers. 15 times book value. Again, it's a retailer. So what is book value? Well, they have they own a bunch of their warehouses. You're paying significantly more uh, when you buy a share of this than what the underlying assets are worth, just on paper. Look at our price earnings. 50. It's got a 50 handle on it. That means that your earnings yield is 2 something percent. In fact, we see, 2.5%. Not only is our dividend yield much lower than the sector at large, it is much lower than history over the last 5 years. One thing to note here, this free cash flow yield, insanely low, less than 2%. There's something about this stock that it's priced in a way that reflects a huge, huge level of safety for the underlying cash flow. And I would say that that's warranted, actually. We're going to take a look at some things to justify that. I think most notably here, what do you see here? COVID was a tough, and I'm talking about the lockdown period of COVID. COVID was a tough period for a lot of brick and mortar businesses. A lot of retail really struggled, particularly small mom and pop retail outfits. Nobody was. Some businesses were shut down temporarily. People weren't going into restaurants. Um, However, people were spending more money at Costco than ever because they were stocking up on things in preparation for the impending apocalypse. So that gives Costco this image and this reputation, this image, this notoriety of somewhat of a safe haven. Those cash flows are safe even in a recessionary environment. In fact, the company might even be recession resistant and boom during a recession because people are leaning into value. And I think that that's warranted. And that I would argue that that is a huge contributing factor to the low free cash flow yield. However, it still pretends that is an insanely low free cash flow yield. I mean, even the 5-year averages are insanely low, and we're lower than that. I mean, crazy, far below the treasury rate. So the market is pricing this stock in a way that its underlying cash flows are safer than treasury bonds, which you can make your own judgment on that, but it's pretty absurd if you think about it, because you have all the equity risk. However, the company has performed exceedingly well in bad environments. Um, it's kind of hard to use the dividend yield chart because of the special dividends that the company pays out. Kind of hard to compare it on a yield versus history metric. However, our yield, our dividend is very strong and growing quickly. So, in terms of the valuation, surely this valuation is logical for a company growing very quickly. Well, we see here the price earnings growth multiple is absurdly high. Um, the stock tends to trade at a strong price earnings growth premium. So it's not that absurd through that lens. Again, this stock has magic properties. But even so, on a forward looking, a price earnings growth ratio of greater than 5, I mean, that's insane, folks. That's just insane. The thing about the company is that it has done well. My time frames are a little janky here. It has done pretty well in periods of distress. I think this might be the best view here. We see what's going on here. So it's kind of tough to use a return graph to make this point, but I will try my best. So if we zoom back to February 2020 and we fast forward to about a month from then to give you an idea of just how far the S&P fell. It was up 64% since 2015 and dropped the equivalent of 50 points of performance. Does that mean it dropped 50%? No, not exactly. It dropped like 30%. But the illustration there is relative. We lost 50 points of performance over a month time frame in the S&P. Meanwhile, over that same time frame, Costco stock lost 13 points. So that gives you an idea um, where the broader market sold off strongly in this period. Costco stock was more flat. You can see that borne out visually here. And then let's also extrapolate that concept to the more recent correction in late 2021, early 2022 in the broader market. It had the S&P 500 had bid up to 127 points of performance over that time frame, and it sold down to 76. So again, that's roughly about 50 points as it pertains to this graph. That's kind of a high point for Costco, so that's a tough period. I guess what I want to point out is let's go from this period. So I'm just trying to make a point visually from this point here to this point here in the Costco chart. You see how it didn't really go below this 200% line. So that gives you an idea that while very choppy, you see the choppiness of the stock. While very choppy, the stock didn't really meaningfully decrease below when it entered that channel, whereas the S&P 500 it did dip meaningfully in that time frame. So Costco has had these properties. The stock has had very strong defensive qualities, where investors tend to see it as somewhat of a safe haven. And unfortunately, what that's done is we have had somewhat uncertain markets the last several years. And so what that's done is, given that Costco is seen as somewhat as a safe haven stock, it's become grossly overvalued. And in fact, we see here, going back as far as I can, the stock is trading at a higher multiple now than, certainly not as high as it was a month ago, but the company has seen enormous multiple expansion over time as investors have bought into the cult of outperformance in poor market conditions. I think that the thesis of that it'll outperform in poor conditions is it's very a reasonable thing for an investor to buy into. However, while the underlying business performance might be very strong in those periods, the fact that the stock has seen a divergence from its historical value metrics as of late and has, become grossly overvalued, I think that does somewhat diminish the ability of the stock price itself to weather hard periods. But even year to date, it's been somewhat of a safe haven. You see how it traded at one point in time, it was up 17 points versus 4%, and still outperforming, although, had some slight underperformance in the last month. So Costco, we see that it still largely continues to trade with some of these safe haven properties. And I think that that's really, um, will that continue? I think it's a little bit murky as to why and when it might do that. Now, I want to look at this chart, and I first invested in Costco with size as it was consolidating in this period, and really felt confident that once it broke out to the upside that it was going to outperform, as stocks tend to do when they hit that pattern. Now what I want to point out is this: it's been trading in a very, very strong uptrend, and these each candlestick is a week of time. This is a 6 and an 18 period candlestick consolidation, and we do see here that the stock has broken down below. I, in good conscience, could not um, grade the stock a buy here, as it's, kind of entering into now correction territory. Then it becomes, where is our base of support? I think this is a level to watch in the, mid to high 800s, 900 today. I'm going to keep it very simple. The stock is a hold to me, because it has phenomenal properties, performance, and the underlying business is somewhat countercyclical, which I like. So I have no intention of selling it. However, this chart does not look good, and it looks to me that the gravy train period that started here and went all the way to here. I did buy it several times as it was consolidating back down along the trend line, by the way. But where we're at now, this to me is somewhat indicative of a regime change potentially, that we might be in a new era of Costco stock. Now, what happened last time, we see here, we had kind of a similar regime here, and then it broke. In fact, let's extend that out. It kind of widened out here, but you see here, it traded along this trend. It broke down below that. It did recover to new highs, but it broke below that. And then it ended up in this consolidating wedge, um, while the underlying business performance caught up somewhat with the stock price. I expect more. I'm expecting it to form another chart pattern that looks somewhat similar to this, where we're at here. However, we are so early to on in being able to tell. I would not be surprised if it created another. I think this is called a wedge. If it created another wedge pattern like this, um, at which case, if it did create a pattern like that, I would start to become a lot more interested in entering into new shares, assuming that the underlying business performance is good. One thing we didn't really talk about was their strategy around growth, how they just consistently are, building 20 to 30 warehouses per year. It doesn't take a genius in math to know that that is going to, not produce high double digit rates of growth if they're focused on building a consistent number of warehouses each year once they reach a certain mass. But very consistent performance. The chart does not look good. However, I don't expect it to just fall like a rock. However, it could. And then you get an idea. These are your levels, right? But in theory, you see here, it retraced from 600 all the way to 400. So that was, 30%. Here, retrace from 1100, 30% would be, yeah, roughly down to here, right? So you could see, again, if it were to create a pattern like this, your bogey is in the 700s there. So I'm anxious to see what happens. I'm always a buyer of this stock at a good price. And let me tell you something, every time I buy shares, I want to throw up because it's always egregiously overvalued. However, I believe that as of late, it's become much worse. So, um, yeah, I think the main risk here is while tariffs are ultimately going to squeeze the end customers of this business if they're going to have any impact at all, because that Costco is just going to give their straightforward low double digit gross margin markup on the goods. So if goods are 20% more expensive to import, assuming that they are imported, then Costco is going to mark that 20% up by its same margin and recoup their costs in that way. That's just how it's going to go. So I don't see Costco's underlying business performance changing much, but it does potentially, throw into question if consumers are going to push back. But if tariffs are on these goods, that means the other retailers are having to contend with it as well. So I still see the value proposition of Costco for customers being strong. The stock, however, does not present much value. However, there is a place in a portfolio for the stock, and the place is for a portfolio that's looking for growth, but wanting to ride out volatility of uncertain markets. And I think that this stock has done a very good job of that. So even though you look at the valuation, you look at all the risk here tied up, the stock has done well when the rest of the market is not. And that in that lens, it's completely different than Tesla for that one reason. For me, I have a strong bias towards this stock. I'm either buying or I'm holding. I'm comfortable with volatility to a degree. I'm comfortable with the volatility in this stock. And if it did trade, back to where I think it might, then I would much more seriously consider buying some more of it. But until then, um, I'm kind of holding out an expectation that it'll do this because we're out of the good times here where it traded up. We've seen that happen before where it trades up and up and up, and then it takes a breather, enters into a consolidation. I think we might be entering into another consolidation. I hope we are, because then that in theory should give the valuation more time to normalize. So that's going to conclude our video today. Hope you found this interesting. I certainly I've been trying to keep my voice down because it's very early in the morning here where I'm recording. Um, so I haven't had a lot of animation here, but very interesting company. Definitely one that every investor should be watching and should be keeping on their radar because it's a phenomenally well managed company, and it has a deep pool of buyers that are supporting the price. A lot of believers in the stock. So when it does fall, it does not fall too far and hits a bid. And I don't see the outlook of the business changing. Um, while the market is pricing it at these insanely low yields, I tend to agree that there is a strong, strong level of safety with the free cash flow. So hopefully you found this interesting. I certainly have had a good time sharing with you. Leave your review below. Be sure to like and subscribe. Let me know how I did, and I'll talk to you soon. All right. Thank you, and bye.